ever thought about the reasons behind why many businesses are required to pay substantial amounts of money in tax penalties to the tax authority? Hello, esteemed viewers out there. My name is Joseph KB Kadzakumanja. I invite you to join me in this segment of Business in 10 as we discuss 6 main reasons for paying tax penalties, as well as strategies that taxpayers can employ to minimize and eliminate this behavior. The 6th reason has caused serious damages to more companies across the world, and you should be aware of it. Number 1. Late return submission. A tax return is a document that individuals, businesses, and other entities must file with the government periodically. It can be on monthly, quarterly, or annually, depending on the type of tax you are filing its return. It reports income, deductions, and tax liability, and is used by taxpayers to calculate the amount of tax they owe or the refund they are entitled to receive. It is also used by tax authorities to assess compliance with tax laws and regulations. It is essential to comprehend the specific deadlines associated with each tax registration to avoid penalties resulting from late filing. Adhering to due dates is the first step in eliminating the penalty for late submission of tax returns. It is important to note that certain taxes require the submission of returns even if no activity occurred during the reporting period. We have included in the description links for more information on the due dates for various taxes, the penalties for late submission, and the requirement for filing nil returns in cases where no activity took place. This is as mandated by the Malawi Revenue Authority and the Zambia Revenue Authority. If you need to understand more about tax return, drop your question in the comment section. Number 2. Non-payment or late payment of taxes. Once you have submitted your tax return, the return can indicate tax liability, tax refund, or it can be neutral. Neutral is a situation where there is no liability or refund on your return. Tax liability should be paid to the tax authorities timely. As with late return submission, non-payment or late payment of taxes attracts penalties. You always pay the tax liability plus the penalties and interest accumulated. Adhering to due dates is the first step in eliminating the penalty for late payment of taxes. More resources have been included in the description section. Third point, incorrect returns, also known as underreporting income or overstating deductions. Income tax is levied on profit, thus income less expenditure. Less income means less tax, and more expenditure also means less tax. Section 11 of the Taxation Act of Malawi defines income as the total amount in cash or otherwise, including any capital gain received by or accrued to a person in any year or period of assessment from a source within or deemed to be within Malawi. This excludes any amount exempt from tax under the Act. Sections 28 to 46 of the Taxation Act in Malawi outline the allowable and non-allowable expenditures. Firstly, reporting your income or overstating expenses, such as including non-allowable expenditures, in order to pay less tax will result in an incorrect return. In Malawi, such actions carry an initial penalty of 20% of the tax liability, with further penalties possible for fraudulent activities. To ensure your tax returns are correct, always seek guidance from a tax professional if you are not sure about the correctness of your return. In the description segment, we have provided information on penalties for incorrect returns for both Malawi Revenue Authority and Zambia Revenue Authority. If you have any questions about whether a particular expenditure is allowable, please feel free to ask in the comment section. To stay up to date on future updates, please subscribe and activate the notification feature. Number 4, failure to keep records and documentation. The failure to maintain proper records and documentation can have significant repercussions for individuals and businesses. In numerous jurisdictions, it is a legal obligation for taxpayers to maintain precise and comprehensive records that substantiate their tax returns. The failure to comply with these requirements can lead to the imposition of penalties, fines, and even criminal charges. Establishing an effective accounting system can significantly mitigate the risk of incurring penalties due to inadequate record keeping. Utilizing accounting softwares such as Easybooks, QuickBooks, Sage, or Excel can assist in maintaining proper records and ensuring that all transactions have the necessary supporting documents. By doing so, taxpayers can safeguard themselves and their businesses from the negative consequences associated with non-compliance with record-keeping obligations. Both Malawi Revenue Authority and Zambia Revenue Authority requires a taxpayer to keep records for a minimum of 6 years. Number 5, value-added tax late registration and failure to use electronic physical device when invoicing. Numerous businesses have been in serious problems due to non-compliance with value-added tax regulations. In Malawi, businesses with an estimated or actual turnover of 25 million or more per year are legally required to register for value-added tax, while in Zambia, the threshold is 800,000 Zambian kwacha. Voluntary registration is also an option for those who do not meet the threshold. Failure to register, when required, can result in penalties. Once registered, businesses are mandated to use electronic physical devices for invoicing purposes. Non-compliance with the usage of electronic physical devices is considered a grave violation and may incur a penalty of 500,000 in Malawi and 90,000 Zambian kwacha in Zambia. We have added links to help you understand more about value-added tax in the description section. If you have a specific question about value-added tax, drop it in the comment section. And the last point, engaging in fraudulent or wealth tax evasion activities. Engaging in fraudulent or wealth tax evasion activities is a severe offense that can result in significant legal and financial consequences. Tax evasion is the illegal act of not reporting or underreporting income or assets to the relevant tax authority to reduce the amount of tax owed. This can include concealing income, overstating expenses, hiding assets, or engaging in other illegal activities to evade tax. Tax evasion is a criminal offense and can result in penalties, fines, and imprisonment. In addition to the criminal consequences, tax evaders can also face civil penalties, which can include fines, interest, and penalties on tax owed. Taxpayers who engage in tax evasion also risk damaging their reputation and credibility, which can have serious implications for their personal and professional lives. A mining company in Zambia has recently been found guilty by the Economic and Financial Crimes Court of committing 18 counts of false statements and returns in violation of Section 43 of the Value Added Tax Act, as well as 13 counts of tax evasion in violation of Section 44 of the Value Added Tax Act. The company had claimed to have purchased taxable goods between May 2021 and August 2022 and used the invoices to offset the tax payable. As a result, the company had been ordered to pay a penalty of 13.6 million Zambian kwacha by September 5, 2023. This is equivalent to 760 million Malawi kwacha or 743,000 US dollars. You can see that this will be a great loss to the company. In 2009, UBSAG, a Swiss bank, was fined 780 million US dollars by the US government for aiding and abetting tax evasion by US citizens. The bank had facilitated the concealment of their clients' assets and helped them evade taxes by creating offshore accounts and offering other services that allowed them to remain undetected. Evading taxes may seem like an appealing prospect to some individuals and businesses, as it could lead to a reduction in tax liabilities. However, the repercussions of engaging in such activities are significant and far-reaching. The penalties associated with tax evasion can surpass the potential savings and may require considerable time and resources to rectify. Additionally, tax evasion can result in legal complications that may tarnish one's reputation. It is therefore imperative to comply with relevant tax laws and regulations and seek expert guidance when uncertain about tax obligations. Presenting false information to tax authorities is easy and simple, and you really pay less taxes. However, how long it may take, tax authorities will find out. Some of the ways tax authorities use include the following. Number 1, tax audits. Tax audits can be random or unsuspicious. Tax authorities verify accuracy of income and expenditure reported. Secondly, third-party information. You might include an invoice from another company as VAT on purchases, for example, and that company may not report the same as VAT on sales. Number 3, information sharing between governments. This is mainly for transactions across borders. Number 4, tips or information from whistleblowers. These tips may be provided anonymously or in exchange for a reward. In Malawi, last time Malawi Revenue Authority announced of awarding 38 million to informants. This is equivalent to 39,000 US dollars. Number 5, other countries such as Canada and France use data analytics to analyze data and identify patterns of anomalies that indicate tax evasion. The factors discussed in this video are applicable to various countries. It is advisable, however, to seek expert advice. Please provide your suggestions in the comment section below for topics related to finance, accounting, and business management that you'd like us to cover in our upcoming recordings. Your input is greatly appreciated. Kindly support our channel by liking, sharing, and subscribing. Don't forget to hit the notification bell to stay informed. See you in the next segment.